Global currency markets are in turmoil, and now the Indian rupee has also joined in. The Fed has threatened to take the peak Fed funds rate to 4.5 to 4.75% by March, which means an unprecedented 475 basis points hike in just 12 months. The dollar index has shot up to 20-year highs, and the US bond yield has risen to highs of 4%, which were last seen in 2008, the dreaded year of Lehman. Actually, the current turmoil is being sometimes compared to 2008 crisis, sometimes to the 2013 taper tantrum crisis. Today, I have with me someone who has seen both these crises from the front seat, as it were. I have with me Dr. Subbarao, former Reserve Bank governor. He took office practically on the week when Lehman went down. He took office on September 6, 2008. Lehman happened on September 15, 2008. And towards the end of his 5-year term, we saw the ravages of the taper tantrum. So, Dr. Subbarao, thank you very much indeed, sir, for joining me. Your perspective is very important to us. First, that is the question. Is the rupee, that vulnerable, like we saw it in the previous crises?
Well, without going into any quantitative measure of vulnerability, what is certain is that the rupee is under pressure. It depreciated by about 10% in the last 1 year.
Yes.
It's crossed the psychological barrier of 80 to a dollar. And foreign exchange reserves have come down by $100 billion from this time last year. We know that that pressure is coming because of two reasons. First, the current account deficit has widened, largely because of the increase in oil prices. Second, because of capital outflows triggered, importantly, by the financial tightening around the world, most importantly, the hike in interest rates by the US Federal Reserve. Now, it is certainly a cause for worry, but like you referred to the previous crisis, it's certainly not 2013, the taper tantrums. There's a big difference between the taper tantrums of 2013 and the situation today. For example, in 2013, the rupee was under pressure. There was a lot of pent-up exchange rate pressure in the rupee. It was overvalued, suddenly bled. This time, I think the rupee is tracking fundamentals more or less. Again, in 2013, we had the twin deficit problem, current fiscal account deficits year on year very high, leading up to the 2013 crisis. Today, this year, the current account deficit is expected to be high, but it's a one-off, hopefully. And on the fiscal, there's more credibility. And most importantly, we have the buffer of the foreign exchange reserves. So it's certainly not 2013. I would also say that it is less of a worry compared to what it was 6 months ago. If you compare to, let's say, March or April, oil prices come down to below $100. Our trade deficit, which was tracking about $30 billion per month, is now about, maybe it'll go down to $20, $22 per month on the average. So it's less of a worry, but I think if this situation persists, we will become vulnerable, and that will depend on a lot of global factors as well as domestic factors.
Okay. So, I agree. I mean, at the face of it, at that time, we were bracketed with the fragile five. Now, actually, people like Ruchir Sharma are bracketing us as the seven wonders, one of the seven, along with Vietnam, Indonesia, Saudi Arabia, etc. So, yes, we are actually in the upper echelon. But, if you dig the current account deficit a little more, the extent to which crude, the incremental pressure brought on by crude was only about $4 billion. So there are economists like Somanan Chakrabarti who pointed out on the channel that from 30 we may come down to 26, 27. We may not really come down $10 billion. Services, a lot of Indians have traveled abroad. A lot of students are studying abroad. So even if you count services, our current account deficit looks like will be well over $100 billion, which means 3.5% of GDP. And since only a small bit is crude, even if crude comes down, our imports are high. Don't you think this is a window of vulnerability?
Well, certainly. There should be no presumption at all that we're going to get into a comfort zone very soon. That's not going to be the case. The rupee is under pressure, will continue to be under pressure. Like you said, this year, the current account deficit is expected to be 3 or 3.5% of GDP. The RBI used to estimate that a safe level of current account deficit for India is 3% of GDP. That was during my time. I think they got more conservative now. Now they talk about 2.5% as being the safe limit. And note this, in the 6 years leading to the pandemic, we had current account deficit at the range of 1.4 to 1.5% of GDP, so in very safe limits.
Yeah.
So we're going to get into about 3%. As I said a short while ago, if this is a one-off, it's okay. But if it's going to persist, and if it's going to come on top of fiscal deficits, which are high, not just the central government, but both the center and states put together, fiscal deficits are still, I wouldn't say scaringly high, but certainly quite high. That coupled with our current account deficit of over 3% of GDP certainly puts us in the vulnerable zone. And we're not going to get into a comfort zone anytime soon.
Okay. You said that if, given the recession fears, crude comes down, we could get a relief. If there are indeed recession fears, even our exports could come down, isn't it? After all, our imports are indispensable imports, some of it like crude and chips, whereas our exports, perhaps, like rice and textiles, are discretionary to some extent. Do you think that if the recession that seems to be now forecast by several economists actually happens, we may have a second year of current account deficit issues?
That's quite possible. The R word is upon us, and I think it's more probable, looks more probable today than it did even 3 months ago. And if there's a recession, our exports will be hit. And the exports have been a big driver of India's growth, particularly last year when we recovered from the crisis. That is driven largely by exports. So if exports are going to be dented because of recession, that's going to be vulnerability on the external front. But on the other hand, like you pointed out yourself, if there is a recession, oil price will come down. So how these two factors will play off, I really don't know. You must ask people, analysts who actually work on the numbers. But I believe that if there's a recession, India will continue to be vulnerable, perhaps more vulnerable than it is today.
Okay. Well, let me come to the reserves now. That is supposedly our trump card. Do you think that is seminally something which puts us better than in 2013?
Well, certainly. I would say that our foreign exchange reserves have been a buffer. But big caveats to that answer. Our foreign exchange reserves were a buffer, a strong buffer last year, but much less of a buffer now.
Oh.
I've seen some analyst numbers say that one metric of measuring the adequacy of foreign exchange reserves is as a proportion of GDP. That ratio, which was, I believe, about 21% last year, FY22, that is the reserves in FY20, end of 22, as a ratio of GDP in FY22, that's 21%. That is likely to come down to 17% this year, FY23. Reserves as a proportion of GDP. That's a big decline. Okay. And if you compare that ratio to what it was in 2013 and 2014, taper tantrums, that ratio is about 15%.
15, okay.
15. So we're not dangerously low, but I would say that our reserves are much less of a buffer than we thought last 3 months ago. And I would also say this in answer to this question, it's not just the level of reserves, but also the rate at which reserves are coming down, the burn rate as it were. I think that also shapes market perceptions.
Okay. Now let me come to other things that the Reserve Bank has. Of course, it has reserves. But do you think it needs to use the interest rate weapon now? Have we reached a time when we have to think very seriously of interest rate differential with the Fed?
We certainly have to think about it, and I'm sure the RBI thinks about it all the time, not just now, but all the time. Okay? Every central bank worries about what their interest rate stance is going to have on the exchange rate, particularly emerging economy central banks. No central bank, of course, admits to using the interest rate as an instrument for exchange rate defense, but all of them look at it. So when they do monetary policy calibration, they always look at what impact it's going to have on exchange rate, particularly because it is difficult to do all these things in compartments. You cannot say, this is monetary policy, this is exchange rate policy, this is financial stability policy. All of them are interlinked. We know this impossible trinity, right? They're all connected.
Yeah.
So RBI worries about it. But in a specific answer to your question, I would say that, the decision point has not come. Because even for inflation management, RBI will still have to tighten. So any interest rate tightening now will be consistent with interest rate defense as well. But down the line, let's say RBI hits 6% or whatever they consider to be the neutral rate from an inflation perspective. Will they then continue to tighten in order to defend the exchange rate? That will be a dilemma. That will be a big question. And that's a decision point, I would say. So it's at this time, it's not a critical decision to make.
Okay. Yeah, I agree with you. At least in your time, you did not have this binding constraint of inflation targeting MPC. That is the kind of a straitjacket now. Do you think they will have to... See, we just discussed a little earlier that imports are growing irrespective or even without counting crude. So can we be in a situation that we have to cool down the current account deficit and the dollar rupee because it is getting exacerbated by huge demand, aggregate demand for imports? So does the argument, even from a rupee angle, increase to cool down demand and go with the interest rate instrument?
The RBI is anyway cooling down demand, right, with their interest rate policy. Okay, so their endeavor is to restrain growth in order to restrain inflation. That's happening anyway. The question is, should that be also targeted at restraining imports? Some of that will happen. But I would say that as much as they're using the interest rate to restrain demand and to slow down the economy, I should think they should also allow a depreciation of the rupee. Depreciation is inflationary, but it is also expansionary. But in my view, I think they allow the rupee to depreciate. It will restrain some of the imports that you're talking about, and it might support exports. So use the interest rate to cool down the economy, use the exchange rate to restrain imports and to encourage exports. And that, I think a mix of that will be a good policy situation right now.
Okay. So time permitting, I will come back to this issue of depreciation, especially because the Chinese yuan has depreciated a goodish bit. But there were another set of measures that were introduced in 2013 by the next governor. It was after your term ended. There were special schemes announced for NRIs to invest in India, where the cost was borne by Reserve Bank. Has the time come for such measures, or do you see it round the corner?
I'm not clued into the nitty-gritty, so I cannot give a precise answer.
Okay.
But 2 months ago, I believe we know that the RBI had taken certain measures to improve inflows, right? They had raised debt raising. They made debt raising easier. There were a lot of banks to borrow. They made ECB simpler or more comfortable, etc., etc. I don't know what impact they've had.
Okay.
To answer your question about whether the swap option or swap scheme that was introduced after my time by Governor Rajan, that worked very well at that time, I should say. Whether we should do it right now, I'm not sure, because it is costly. And also, it's like, let me use a word, it's like a Brahmastra. So if you use that, the market might get spooked.
Okay.
So I don't believe the time has come. If RBI or the government together want to do it, they must be very, very circumspect about whether they should do it, when they should do it, and how much of it they should allow.
Okay. Fair enough. Dr. Subbarao, I have to take a quick break, but I have some more questions on how the central bank can use some of its weapons in this suddenly dangerous external situation. I'm back in a minute.